guys. So, just in case not everyone in this room is super familiar with what these guys do, I thought I would just sort of go over things quickly. Michael's Cendana Capital is a fund of funds that funds seed stage venture firms. He's grown by leaps and bounds in the last 7 years. I think his first fund had $28 million, and he just closed on $260 million this year. Lisa Edgar is a managing director at Top Tier Capital Partners, which is also a fund of funds, but backs sort of Series A and more established firms. Lisa's been there for 14 years and worked as a banker and an analyst at Horsley Bridge before that. And then Mac, who I've also known for years, has worked in VC and private equity and works for a placement agent, a global advisory firm called GCA. So guys, thank you so much. You know, I'm guessing there's VCs in the audience who want to get money out of you. So, Lisa and Michael, I thought maybe we could start off by just talking about like the next 12 months. What do you see happening? How many new firms, or how many firms do you see sort of backing, and maybe how many of them could potentially be new investments?
Sure. So, as you mentioned, we raised our new funds in April, and generally we're on a 3-year cycle. And so, once you get the flywheel going, you know, from a fund-to-fund perspective, we have a lot of re-ups as our existing fund managers come back to the market. And if they're tracking quite well, if there's no style drift, we will largely re-up with them. And then, so what we've done actually is create a pilot program where we invest much smaller amount. Our typical investment now is 10 to 15, but our pilots, we do up to 1 million on groups that we really like, but have some question about either their strategy or the sector or geography. And so those are ones where we actually have to do the real work and consider, should we convert this pilot into a core? So just to give you a sense really quickly, our portfolios are about maybe 10 core, about 5 pilots generally. So our portfolios are generally concentrated.
Lisa?
Yeah, if you're looking to see what is in the pipeline for the next 12 months, I think it's going to continue to be a very active time period for funds coming to market. As Michael said, we also have an established program, so we work on our re-ups, those managers that are coming back that we'd like to continue to back. But we always have time for new funds and new managers and new strategies, and we like to back those as well. It looks to be a pretty active time. There's there's a lot of interest in becoming a venture capitalist, becoming an entrepreneur globally, and we see that, and as we all talk about all the time, with the current interest rate environment, et cetera, this is really an attractive time. So I expect the next 12 months to be quite busy with both re-ups and new funds.
That's great, and I want to get into more specifics about what you're seeing, but Mac, your job is a little bit different. So are you being contacted or proactively reaching out to sort of more venture funds, or has it flattened, or is it possibly even
Yeah, it's interesting right now. My pipeline of new venture funds is as strong as it's ever been. And historically, the last 15, 17 years, I've done one project a year because of pipeline constraints and only wanted to work with one manager to focus on them. So choosing a manager is challenging, and usually in years past you've had to sell your services to them. Now we're being inundated with some very high quality firms, and it's a combination of, one, I like to think we do a good job. Two, demand for venture capital from LPs is waning a little bit because a lot of them are over allocated, and there's a gap between commitments going out the door and distributions coming back in the door.
So you're talking about traditional LPs, like institutions,
traditional
pension
LPs.
funds.
And so that's creating some challenging fundraising conditions for established managers who may be doing a good job, but may hit a LP in between allocation schedules, or they don't have capital because their board has slowed down their deployment pace. So that pipeline is very high and have an opportunity to work some very high quality established firms. On the emerging manager side, there's been an abundance of emerging managers, and picking those, if anybody's in the fund selection business, is hard. Usually I'll do one of those a year as well, and that bar has gotten very high because the market has changed on what the market wants. So you have to be able to identify something that is going to get through the market, high quality, good returns, a reasonable strategy. And that right now is as high as it's ever been. So venture, you're saying active, I think it's just off the charts right now as far as activity and funds getting created, which is good, but I think the capital is starting to slow down. So there's where you're seeing a little bit of a gap.
Right, and actually one of the biggest risks is you have the denominator effect where if you're an institutional LP and your public equities and fixed income portfolios have grown so much, 20, 25% in the last year or two, then if you have a specific allocation of private markets, private equity and venture, you're supposed to be deploying more capital. But if those equity markets go down 10, 20%, then suddenly LPs think, oh, we're actually over allocated. And I think that we're at a point now where a lot of the institutional LPs are getting worried that they're going to become over allocated if there's a market correction.
Right, and they're still waiting on returns too, so
Right.
that's an issue. So Mac, just going back to your point about how merging managers, the bar has changed. So, November 2017, does the sort of like VP level person who spun out of Facebook and has great relationships have a better shot than the sort of promising principal at a hotshot VC firm who starts their own fund, or who's sort of like the most?
Yeah, and this is going to be a simplistic timeline, but in 99 to 2011, or excuse me, I'm too old. 2009 to 2011, these new seed funds were that.
Which?
Were people spinning out of Facebook, coming out of Google, and that's kind of, Gen 1. I think now you're seeing people spin out of established firms that maybe they were at, pick on a, Kleiner Perkins, and they want to get in the seed business. And that was kind of the second wave. The new wave is unclear to me because there's so much of all of those two things in the bucket. It's hard to predict what's going to be successful. I'm not the smartest guy in the world, but I can spot a trend. And the seed fund market is a little crowded. And I said this at my roundtable today. There's an abundance of venture funds being formed, but there's not a bunch of high quality funds being formed. And they said, well, what do you identify as high quality? You kind of know it when you see it. There's an it factor. It's not relationships. It's not working at a big tech company. It's being combination of all those features that drives a great venture capital firm being created. And I just have seen enough firms created and kind of can identify it. But right now, I haven't seen many of those coming out because people are making too much money inside of other firms to leave. So there's a little bit of a dislocation of what the next big thing is going to be in kind of venture funds.
What I see, it's kind of interesting because we see new groups every day, but it is a kind of a combination. It's these people that maybe were operators, but they actually have some investment experience because maybe they had a syndicate on AngelList or something. So they kind of have a combination. And I will tell you, people now know what the LPs want to hear because in some ways, we've put on workshops. Michael has his big conference. We've basically told people about portfolio construction. And so now it's even harder still to discern quality because everyone at least kind of knows what they're supposed to do. But of course, the devil's in the details, right? It's really hard to do.
That's interesting. Well, for some reason, I didn't expect that the LP money had slowed down. I guess I figured if those sources sort of put the brakes on things, there was still so much money, from sovereign wealth funds and other sources of capital. Is that not the case, or?
So that's their clientele, and that's why they need, because they have large amounts of money to deploy. They can't do it themselves, and that's a great service. The people that deploy directly right now are seeing a little bit of a shortfall just because they've had venture programs going back 30 years. So to add somebody, they got to kick somebody out. And that makes it a challenging selection process. And this, I harp on it. I don't want to be the harbinger of kind of bad news at an exciting venture conference, but there is a lack of liquidity in the venture market that is unbelievable right now. We work inside of an M&A shop, and the amount of companies who are trying to get sold from where they are valued at the last round to what the reality of what the market will pay for that is as large as it's ever been. And that's creating a great challenge for many entrepreneurs. Do I sell? Do I wait? Can't raise additional late-stage capital. What am I going to do? And that's a big problem every venture fund is facing right now. And they've got to solve it because LPs aren't going to give more money out to people that do not send them money back.
Right.
That's just a new development.
And you're investing, both of you, at such an early stage, so obviously it takes longer for these companies to exit, and the timeline's gotten longer and longer. So how are you sort of dealing with this issue?
I mean, it's a double-edged sword because, if you're a seed fund, your company starts raising capital, it does really well, suddenly it's a unicorn, they raise a couple $100 million. But if you're the seed investor in that company, you're actually a hostage in that valuation because the company probably has a huge monthly burn. The new investor coming in at $1.5 billion wants a 3x from there. So you got to think, well, how's this company actually going to exit at $4.5 billion, $5 billion? And that may take 10 years. And so if you're a seed investor, your alignment of interest is shifted away from the later stage investors. And our advice to our fund managers is actually, if you have a 10x position, 10x NAV, sell 10 to 20%, sell 30% of it, monetize it, get your money back to the LPs, and then you still have 60 to 80% riding on the company. Sometimes I think seed investors get this romanticized sense that they're tied at the hip with the founder and they're creating this great company. But at the end of the day, they're investors, and their own investors, such as the LP community, want some distributions, and we want it now.
What's happening on that front? Because obviously I see your point. You want them to sell part of their position, and I'm sure in many cases they want to sell part of their position, but it's often those unicorn companies that, or maybe things have changed, don't really want their shares trading on the secondary market. What's happening?
You can sell it in the next round to the new investors because they usually want to buy up ownership. So there is a very, very active secondary market in these shares, both from these online sources that you hear about, but actually within the institutional base. Almost every venture investor will buy secondary shares as part of their investment into the next round to actually get some additional ownership. And we've both sold and bought, in our firm.
Well, the best thing, we were talking to the gentleman this morning, and the best thing Europe can do to encourage venture capital formation and startups is fix their IPO problem. Because that is one of the single biggest problems in the States right now. We overregulated and killed off the ability to go public to where it's onerous to become a public company, and people don't talk about that enough in the States.
Well, I don't think there's a total consensus on that,
But no one's fixing it. I mean, everyone is good at identifying the problem, not solving the problem, and you're stuck. So held hostage, it's going to bring down some companies because they don't have a trigger to liquefy their shareholders. And that's just an ecosystem problem. In the new venture ecosystems that are starting, I always say if you get the right infrastructure in place, you can create a great business. And that's something that the US, just because of its history, North America has a big problem with. And it's going to become a bigger problem as most of these companies go on 13, 12, 14 years. We just sold a company that was 15 years old. At one point, it was worth $5 billion. It sold for like 150.
Right. Yeah, the LP panel earlier today was talking about this issue too. Like at some point you're growing 100% per year, and then 10 years later you're growing 20% per year. You're not going to get the same thing. But I was just saying, I don't think it's. People obviously argue over whether it's really a structural thing or it's they were choosing to stay public, or choosing to stay private for not wanting to be in the scrutiny of the public.
Well, yeah. Now you have SoftBank Vision Fund, right? So that is a huge source of liquidity, and for our fund managers, the seed fund, they are viewing it as a source of exit, actually. So
I wanted to talk about SoftBank a little bit. I want them to talk about a bunch of stuff. I hope we have some time. But so if I were a later stage investor right now, I would be very, very nervous because these guys are putting $100 billion to work, and ostensibly there's a lot more to come with all of their LPs wanting to get into these deals. So, my understanding is they sort of, their LPs have a different expectation. It's not, it's not the 10x. It's like it's like a 20% IRR over time. So they don't have to get the insane returns. They have all this money. So how do later stage funds compete with these guys when they can just walk in and be like, look, we'll double what they're offering, and we'll hold it for a longer period of time?
Yeah, I think it's hard. I mean, the good news is, at least Michael and I, and you do a lot of more early stage, so it's very difficult. It has been a huge disruption to the ecosystem, and I think we're all trying to figure out still how it's going to play out. I mean, there's talks about them doing their next pool of capital. A lot of those investors are strategic even, not even looking for probably much return on top of that at all. And if I was a late-stage large platform, I would be quite afraid of the competition there because they'll pay up and such. There's been a lot of late-stage capital sloshing around the system for a while, though, so this isn't new. It's just so big and so in your face.
Right. I know we thought it was bad a couple of years ago, and now it's...
And it might be kicking the can down the street. And that's, we have a joke in our industry that the problem is when you get a lot of data, you can get analyzed. When you're selling the dream, there's no... anything to put basis, it's all opinion.
Right.
And so a lot of these companies have an intrinsic value. They have a growth rate, they have an EBITDA model or not, and you can value them. And once you get valued, it's hard to get around that. So if someone comes in and overpays for that company, that just puts the problem further down the road. So it's a market dislocation. I mean, if you go to the big capital markets theory, it's not that there's too much money, that it's going at certain points of inflection in perpetuating the problem there, so it's not efficient. And that's what needs to get fixed. So if SoftBank buys a bunch of companies and then turns around and goes public, that might be a great idea. I'm not saying that is their idea, don't quote me on that. But if that was their idea, that'd be one way to provide a bunch of liquidity. So it might be a good thing, but also if they just do a bunch of later stage rounds that just overvalue companies more, it's not adding much value, in my humble opinion.
Well, it's a little bit like the Andreessen Horowitz model, where they came in and they started writing these huge checks, and it changed everything. But SoftBank might be thinking, so it looks overvalued, but now nobody can compete with this company that we've funded. So that, the landscape completely shifts. I don't know. I think it's super fascinating. But okay, so that's one big shift that's been trending through the tech ecosystem. Another, obviously, is ICOs. I don't even know where to start with this, and I'm actually doing a panel with some investors tomorrow on it. But how are you hearing from, again, maybe you're too early stage, I don't know, but are you hearing from your firms about revising your LPA agreement?
We have a pre-seed fund in New York called Notation Capital. They actually participated in ICO in their prior fund, so they actually have a position of tokens. And their argument is, look, these are companies that have a foundation, and so the foundation is sort of the structural thing. You have your your ICO of a token. The token actually has no ownership in the underlying asset, and so the value of the token really is based on trading dynamics, which right now is speculative. And just in the last 3 or 4 weeks, you've seen the news with like Tezos having issues. You've had a lot of broken ICOs, and I think with the SEC overhang of potential regulation, the Monetary Authority of Singapore said that they're going to take a bigger look at it, and that's where a lot of the frameworks was sort of being leveraged. I think it's a very serious, it's a potential disaster waiting to happen. But to answer your question specifically, we have seen some of our portfolio funds change their LPA so that they can actually hold these things, and it might give them a little bit more flexibility, but our advice to all of them is actually not to do it.
That's interesting.
Lisa, yeah.
That's interesting. We've had some fund amendments as well, and they're thinking of it as more of a public security, and therefore they're they're coming back to the LPs to increase the % in public securities, is the way it's kind of manifested itself so far. We've had some companies that started with an ICO, and then they made an investment in the company, and then we've had it the other way around, where they invested in the company, and then the company raised an ICO. In that latter case, they usually buy the ICO at a discount, so they're not paying the full price, and they're getting in actually before the full offering actually takes place, which is kind of interesting too. Frankly, I don't know what the heck to make of it. The world is going towards blockchain for various business use cases. The ICO, there's a lot of money being raised. A lot of it, there's nothing behind. Some, there are real companies. We don't tell our managers what to do. We haven't invested in 100%, cryptocurrency fund. I can't imagine we ever would. But there's small seed managers and big name brands that are active in the space. And like a lot of people have said today, it's happening. It is being venture backed, and so we're going to have it in our portfolios for sure, and we do.
Well, everyone got mad at Jamie Dimon when he went off on cryptocurrencies and ICOs. he was just protecting his domain, because an ICO is just a security by another name. And that's where the SEC is going to clamp down on that quicker than anything. So if you're in the US and you're doing it, it's going to be a big problem here pretty soon, because they're in business to protect widows and orphans, and widows and orphans are buying ICO cryptocurrency backed, and that's just going to go away. The concept behind it, cryptocurrencies, who knows? That's a different, how they get traded, what, that all is going to be a great business and ecosystem for currency and fintech. Two different things. So I think the issues are getting clouded because of the ICO. The ICO is just another way to raise money, and that's a bigger issue for the securities regulators. Cryptocurrency and blockchain and other fintech-related businesses, those have real hope and potential, and I think that's where people just have to sift through the issues.
I guess I disagree that they're going to go away, although I wish they would, because I still don't completely understand how, you know, these
Michael
deals
and I are
work.
going to do an ICO
Yeah.
today. We're having after cocktails.
But you would seem to be the person most sort of liable to be disrupted by these things. I mean, because if your clients, portfolio companies start just raising money without them, that's a problem. But you don't. You also think that these are not
Right. So I think
long
what you're
as well.
describing is a scenario where our seed funds are disintermediated because of the ICO and tokens, and they're somehow now, you know, rendered useless because all the companies want to just raise money. Now, so what you could look at also as perhaps you know, an analog is, you know, Angel List, run by a super smart guy, Naval Ravikant, actually put out a new program called CoinList actually last week, and it's a platform where you can actually, and anyone here who's accredited can go and buy into an ICO. And you know, I think, and I said this before, you know, Naval is a genius, but the companies that have raised off of Angel List still are not perhaps the highest quality companies, other than, say, you know, some of their examples like Uber, because I think, you know, CEOs and entrepreneurs and founding teams want to work with people, want to get their, want to work closely with their VCs, want their advice, want introductions to partners, want introductions to customers, and help on product roadmap. And you can't do that when you're selling when you're raising money to, you know, either kids sitting in China or, you know, in Germany or wherever, and they don't give a shit about your company. They're just doing it because they want to take advantage of that trading dynamic.
You're trying to add public security trades to a private market, and that's just, it's an asset liability mismatch. And structurally, you just can't do it. So it goes back to the IPO problem, is the liquidity. People are looking for liquidity, and they're trying to create fringe elements to generate it. Totally understand why. It makes a lot of sense, but I think people aren't taking a step back and looking at the bigger picture and coming up with a more holistic solution. And that's just, somebody's got to do it. I mean, maybe, Michael, you retire and you go and get appointed as the czar of the IPO.
I don't know. Maybe I've just been talking to too many of like the proponents, but I'm surprised that you're so dismissive of it. But we'll see, I guess, in maybe a year or so. Okay, so there's huge structural stuff going on. Against this, there has been, you know, I'd say the last sort of, not last, but another sweeping challenge in Silicon Valley has been sexual harassment. At least that's been sort of top of mind for a lot of people this summer. How has that, have these conversations sort of impacted how you approach your work? I guess, first of all, you know, was this that people didn't know that VCs were behaving badly, or was it just sort of culturally more acceptable and suddenly it wasn't? Michael, what do you think?
Yeah, I mean, you know, in a way, a few years ago, Ellen Powell with her trial, you know, her suit against KP, you know, it was heavily covered, but I don't think it was still not the right moment. And then, you know, with the memo that came out of Uber earlier this year, and a lot of reporting by the press, the tech community press, you know, I think that really has created a situation now where you have this, you actually do have a sea change in attitude. And even since Connie, you and I last spoke, you know, with the allegations around Harvey Weinstein and, you know, within old media, within Hollywood, I mean, that is becoming a complete deluge of allegations and people being outed, and I think it's all for the positive. And so, you know, I mean, the cynical way to perhaps view it is, well, it's men behaving badly, but the bottom line is that's inappropriate behavior and oftentimes illegal behavior. So I think having that bright sunshine put on what's happening under the table or in the room, I think that's a great thing, and I think we're going to hear more of it, actually.
Do you, I guess, we'll probably hear of more cases, but I'm wondering, so you nicely came to an event I hosted in San Francisco in September, and we talked a little bit about this with another LP who said, I feel now that I'm emboldened to maybe ask questions that I couldn't before, and also people can tell me, offer information that they might not have before. I guess, are you seeing that? Or do you feel like you can ask other questions, or do you feel like things will switch back to sort of like speaking in code? Because the concern, obviously, is that you don't want to be sued by somebody for disparagement. So it seems sort of like
Right.
very complicated, obviously.
I'm going to take a little bit of a step back. About 3-4 years ago, the National Venture Capital Association in the U.S. created this task force on diversity and inclusion. And a lot of people joined it, and we had a lot of discussions, and things were happening. But then fast forward to today, the thought was there was a spotlight shown on it. So the more we talk about it and think about it and really, have a whole industry association that is setting up some guidelines for that, we can really make some change. Fast forward to today, I went to a workshop. It's diversity, inclusion, and harassment has been added, which is kind of interesting. And actually the women that stepped forward in the binary case were in the room. So we were there with the chairman of the NVCA, and there was about 50 of us. They were GPs and they were LPs, and we were having discussions, and they did lots of these discussions all over. But what it has enabled us to do is, we've always asked the question, there's a lot of women LPs, and there's a lot of women in our firm, and we've always said, you don't have any women. So I've said that for years, and I've helped women find various roles in various firms, and generally they go to the firm where there's already a woman, or whether it's some diversity. That's just a natural thing. But we did add to our due diligence checklist about outstanding cases or violations or legal actions or any of this thing. And so now it's just a conversation that we have regularly that I think, it's true. People have actually been given the ability to want to do that and to feel that they can do that as an LP. And, we do it, and so do a lot of others.
I hope it doesn't become a witch hunt. And there's a lot of bad behavior going on, and going back hundreds and thousands of years, and it's shocking that we haven't been able to fix it. As a father of a daughter, what I'm helping her do is become a strong personality, learn STEM, become her own person, and be smart enough to not be able to get caught up in that. Not criticizing anybody, I'm just saying that it's a problem, but it can be solved from multiple dimensions. And I think
I don't know
that's
if
the
it
hardest
matters
thing.
how smart you are if somebody's a predator.
No,
I'm just saying,
I agree with you. But avoid certain situations and avoid people, but also weed out bad people. There's a lot of bad people in our industry. We talk about it all the time. I've had a chance to work with some great venture capitalists I turned down because they're just bad guys, in my opinion.
Yeah.
And it's just my radar of certain things. And I'm also, people are free to live their lives and do things. Don't be bad to other people. It goes back to the golden rule. Treat people like you want to be treated. Sounds simplistic, but sometimes the simplest solutions are right in front of your eyes. And that's the thing where I just want to make sure that it just doesn't become fashionable to attack people, but at the same time, you got to weed out the problem. And I think sunshine is the best transparency for a lot of these things, but you got to be careful that it doesn't, because it ruins people's lives. One bad accusation ruins somebody's lives, and I think that's also not fair, and vice versa. So I always kind of look at problems multidimensionally and trying to find a great solution, and it's not an easy problem to solve.
No, it's not, and I agree that you have to be obviously very careful. But in terms of your work, so you said you can only take on basically one existing fund a year and maybe one emerging manager. So have you changed the questions you're asking just to make sure that you're
So I've always had a filter for what I call after hours. And I like to have fun, and I travel, and I enjoy people and dinners. But what you have to look at is how people treat other people, and you can see it. Like, I go to dinner with clients before I even engage them. They're rude to the waiter. I mean, I have little tests that I watch. They talk about their kids or how many cars they own. I mean, it's just simple things, but you kind of, when you've been evaluating people for so long, you get little checklists, and you just kind of know it when you see it. But it's, you know, you're often wrong. Sometimes I've missed, and some of the guys you think turn out to be, that were good guys, turn out to be bad. So it's not easy.
Foolproof, right.
Yeah, but it's just, it's a bad situation. And I think I'm glad it's getting fixed, because in Silicon Valley, we've seen a lot of bad behavior. I mean, it goes back 20 years. There's a lot of things that people aren't remembering that went on.
Right, they just didn't pay enough attention to. I'm glad, too, that it seems to be having much wider ripple effects. I hope that continues on. So, okay, let's sort of like zoom back into what you're looking for in deals. There was, again, this LP panel earlier that I found really interesting, and some of the things that were brought up were, one of them was the STAR system that the venture industry seemed to sort of, I don't know, encourage or, but, you know, we had Jim Breyer, who's here, of Excel, John Doerr. I think those firms sort of got away from the STAR system because it obviously made succession harder. But at the same time, you can sort of still see the argument for it. You know, having somebody out there who's high profile and beating the drum, and founders think of that person in that firm. How do you, as investors, feel about this? Do you sort of, is that part of your calculation?
Well, we look at seed funds, and they are typically 1 or 2 people firms, and so we don't really have that. But as you're describing the situation, I was immediately thinking of Sequoia, and Sequoia is one firm that was formed in the early 1970s that has done a tremendous job in terms of generation transitions. And what it is that they want each of their partners to be a star. And it's not so much that there's one illuminated person who's running the show, but rather each one is supposed to be at that level. And I think with that kind of expectation, and Greylock is like that too. Greylock transformed their partnership into a group of ex-operators. And I think that is a mission that you could argue they did very well. And I think, you know, ultimately each person is expected to be the star. I mean, I don't think I'd want to invest in a firm where it's that person's show. And one of our best fund managers is Jeff Clavier, and he specifically, as he was building his firm, repeatedly said, I don't want this to be the Jeff Clavier fund. It's soft tech. My partners are Andy and Steph.
No, and he's pushed them forward too for, you know, public speakings.
Exactly.
Lisa, how do you feel? Do you agree with Michael?
Yeah, I think it'd be hard to invest in a fund when there was just one star, just for the longevity, because we don't invest in one fund. We're usually investing for a few funds, and so you look at that. You're always doing attribution analysis to see who's doing what. And in today's day and age, you know, people do have to have their personal brand, though. So everybody really needs to be a star. And everybody usually plays a different role inside the fund. You know, I was just talking about one fund recently. There's 2 people. One is clearly the superstar. The second person is a good investor and plays a very important role. So you see that, you know, a lot of times. But we would shy away from something where one guy, especially if they're taking all the economics and stuff.
So the old days used to be about one person. Now it's become more team-oriented. I think the right word is collaboration. So you're going to have some people that end up being stars. They get one deal. It's kind of a one-hit business. All of a sudden, they become identified as the, you know, star of X. If you look at the data, just simple data, it breaks down. Some people have good track records and some people that don't. I think as a fund management issue, the managing partner has to be able to manage talent allocation and capital allocation across the spectrum of team members. And if you have someone on team that isn't pulling their weight, I think it's incumbent upon you as the general manager, the managing partner, to change that. And I think as funds get older, not enough people have been proactive on making those decisions, and then you question their overall judgment. So we've looked at many funds together. You look at individual track records, and it's not being mean. It's just saying, you know, XYZ partner hasn't pulled their weight. Like, why are you keeping them around? And I think that's going to become more prevalent as firms get older. And I think some people have shelf lives. You know, some people that are doing social media investing in the, you know, few years back, that may not be the wave of the future. So I think that's what makes it hard in venture, is determine what's going to be the next star, because you've got to predict multiple factors. And that's unknown. But I do think that in venture, it is a very brand-oriented, individually-oriented business. And that's going to be the way forever, because you have to have someone get passion behind an idea.
Right.
And it's not going to be, if you ask your group, who wants to invest in this company, they're going to have 50% say no and 50% say yes, and then you have no decision. You can't make decisions that way. Someone has to be the charge behind a deal, I think.
Other things that came up earlier that I thought were interesting was Joelle Caden had said, you know, she's really turned off by firms that will sort of talk about their unicorn holdings, but they have like 1%. When you are investing in a manager, what's your expectation? Do you talk to them about, you know, what percentage of a company you would like to see them own? Is it sort of like your...
Yeah, I mean, this is one of the things that I think we really push for. It's one of our primary filters, actually, is portfolio construction. And, you know, our thesis is that smaller funds outperform. The average exit in venture is 100 million. So if you own 1% of a company exiting at 100 million, 1 million doesn't move the needle. But if you own 15 to 20%, it returns a meaningful part of your fund, you know, especially if you're, say, a $50 million seed fund. So we're extremely focused on how the GP is thinking about portfolio construction, and it's because fundamentally there aren't that many exits above 100 million in venture.
Yeah, we care about ownership. I just can't stop, you know, and all of the others like Naval and like 500 Startups, I get what they're doing and it's working for them potentially. It's just not the way I was trained. It was always ownership, because you're going to have companies go to zero, but if you don't own the ones that matter, it's just not going to make a difference. So you want the winners to return at least half the fund, hopefully the whole fund, and then let the rest ride. Then you can get your 3 to 5x that we're looking for. So for me, I still am an ownership junkie, and I really demand that.
I come home and my daughter has nothing but unicorns in her room, and I cringe. Like, I've been trying to escape these all day. It's good to have a unicorn exit, not a unicorn on your portfolio. So I agree fundamentally with Joelle is saying. And it's not fair to unicorns. It's all about multiple. If you can have a 10 or 15x exit and you own a bunch of the company, that's all that matters. It doesn't really matter what the exit value is. It has to be certain, you know, large enough to generate gain. But I think people are focused, they focus people on the wrong thing. It's about the exit, not the current valuation. And that's where I think Silicon Valley has to get more, and venture capitalists need to get more focused on exits and liquidity and what is a company's true value in monetizing it. There's an old Wall Street adage where a guy's showing everyone his house and his art. He said, "What'd you do for a living?" He said, "I sold too early." I mean, that's what a lot of unicorns wish they would have done. Mm-hmm. So I think that's something that, as a portfolio manager, you need to make proactive decisions on when to hold, when to sell.
What do you do in the situation where you do have the really promising manager who was rising through the ranks of a venture fund and maybe sourced some really important deals, but you know, the fact that the company has not exited is well beyond that person's control? Do you give them credit for those deals, or?
Yeah, absolutely. I mean, you're looking at total value multiples, and you're looking at distributed value multiples. You know, most of us that are in the business, we're pretty close to a lot of the companies, so we kind of know where is the company, what's the expected IPO date, you know, what are the other investors saying, so you have an idea. But if they have no liquidity at all and they've been in the business for 10 years, that would be a huge problem. You know, so you're looking at both numbers. But yeah, I mean, being able to have a company and find it, invest in it, get on the board, you know, have it have multiple up rounds, and you have a few of those under your belt, plus a couple, you know, actually exited companies, we'll look at the others too.
Also, related to that, when we do our diligence on a potential fund manager, and let's use your example of perhaps a principal at an established VC fund who worked and sourced on a company, you know, what fundamentally we do as our diligence is to talk to as many founders of the portfolio companies as possible, and you know, find out what role did that firm play, what role did that person play. You know, if the best thing that we can hear is from a CEO is that is the person who I call for advice. He's the first, or she's the first person I call. And that's the person I'm texting at 11 p.m. at night when I'm stressing out about this decision. And so that kind of feedback from a founder is, in my mind, very dispositive. It's what makes me feel confident that, you know, even if it's a principal, a non-full partner at a firm, that person has the hustle and the relationship, and, you know, ultimately will do that at his or her own firm.
And I'll just add, at some point in you got to add value somewhere, whether it's advice or monetization, and that's what you have to scrutinize when you're evaluating venture capitalists. So I agree with, but at some point you have to do something, whether it's good advice, and I think too many people take credit for things they didn't do in the Valley. Shocker.
I was going to say, really?
I mean, I was the original investor in Google, but I don't want to talk about it.
Well, guys, they are giving us the, they're pulling us off the stage here, unfortunately. Thank you so much. Really appreciate it.
Thanks, Connie.
Nice talking to you.